Well, my friends, my name is Bob Carr. I'm Professor of Business and Climate at UTS, and I'm focused with you tonight on what's happening in the corporate sector on the climate challenge, because my impression has been it's hard to keep pace with how quickly things are moving on the corporate scene. And in fact, when we despair of what governments are doing or what governments are capable of, it's sometimes pleasant news to catch up with what's happening from private equity, from banks, from pension and superannuation funds. Things seem to be changing with dramatic speed, and they would need to. In the last couple of days, I've tweeted a number of stories about climate, but the most concerning one was from the Washington Post. And it's a story of how the disintegration of a permafrost and the pluming of methane from disintegrating permafrost in Siberia is happening at an accelerated pace. And according to some scientific data, methane is emerging not just from old rotting swamps, but from hard surfaces, from rock surfaces. In response to a heat wave in 2020, the saw temperatures really punch through previous highs. So more deeply disturbing evidence out of the northern summer, and something that reminds us that in the middle of COVID, the climate risks are mounting, and this climate crisis is a very real one. And of course, in a year dominated by climate diplomacy. Our panellists, as you all know, because you've read their qualifications and I won't repeat them, are James Taylor, Iris Davila, Nicole Bradford, and I thank them for joining us to deal with this, with their superb qualifications, with this hugely important subject. And I want to begin by asking James, as I'll ask the other two, can you, James, give us a crisp summary of how your organisation moved on climate considerations and its investment decisions? How did this come about? And we'll explore what it means in practice. James Taylor.
Thanks, Bob, and good evening, everybody. So at Ellison Capital, climate considerations are firmly embedded in both our investment philosophy and our investment process. What does that mean in practice? It means that every investment decision considers whether climate risks are material or climate risks are an opportunity in the context of every investment that we might make. This extends also not just to the investments we undertake on behalf of our clients, it extends to us as individuals and us as a business. And thus our corporate culture. So we're currently going through the process of developing a public climate policy, which will not only reflect how we invest our clients' money in this responsible way, but also how we go about our working lives doing that. So how we go about offsetting emissions related to our travel, how we go about making sure we source the electricity that keeps our lights on, our PCs on responsibly.
Iris, I wonder if you could answer the same question. How did BlackRock come to make a decision that I remember at the start of last year got a lot of attention, notwithstanding the advent in early 2020 of the COVID pandemic?
Thank you, and good evening, everyone. Just to make reference to what you're saying, so at the beginning of 2020, in our annual Dear CEO letter that our own CEO, Larry Fink, writes, he set out our investment conviction and our strategy, which is essentially that sustainability risk, including climate risk, is in fact investment risk. And so that an integrated, sustainably built portfolio could really help investors build more resilient portfolios and achieve better long-term returns. And that's something that really has been an evolution of our thinking and frankly, those letters over time. It touches to a couple different things, right? It talks a little bit about, we have been advocating for a long time in terms of really trying to focus investors on the long term versus the short term. And so to do so, we need to think about long-term risk, and climate is certainly one of those longer-term risks. In terms of what we've actually done, I'm happy to sort of go through that a little bit in a bit more detail, but it does include some of the things that James mentioned, and keeping in mind that obviously we are, while we do manage assets across the board, a majority of our assets are actually index portfolios. And so that does help our long-term perspective, but it does include building sustainable portfolios, increasing access for clients to sustainable investing, and the job that I do, enhancing sustainability and stewardship. But I might pause there because we can continue to go on and pass it on back to you.
Yeah, thanks, Iris. And Nicole, the movement of superannuation has been a very significant part of this picture. Would you agree that superannuation funds have set the pace in this debate in Australia? Nicole Bradford from CBUS.
Thanks, Bob. And for those who may not know CBUS, we're a $65 billion super fund, and we have around 800,000 members, primarily in the building and construction industry. Now, in terms of setting the pace, I think absolutely we're part of setting the pace. I think it's really a global agenda that set the pace. So what we've had is the Paris Agreement, and we've seen a lot of asset owners and investors broadly, companies and countries respond to that. And when we've also had, that came out after that, the the panel of climate change with their special report from a science-based perspective. And then what we had that followed that, of course, was the TCFD, so the Task Force on Climate-Related Financial Disclosures. In conjunction with that, we've had a lot of weather events. So we've got this coalescing of these signals that really direct, I would say, countries. We now have over 70% of emissions globally captured by country commitments. And we have a number of investors as well. So I think we're part of a much larger movement. As global investors, we see what's happening overseas. You mentioned the policy environment in Australia. However, we do see a lot of traction and trajectory overseas, particularly if you look at Europe and what they're doing in regulating both the investment manager side, but also the pension fund side, so superannuation funds over there on climate change and disclosures. So I think we're part of a broader movement, but I think it's absolutely imperative that super funds really drive this, because fundamentally we're investing our members' money on their behalf for their long-term retirement outcomes, and we do that both through investment managers, so we need to affect change and influence them and how they invest our members' money, but also we invest directly ourselves with companies, so we need to make sure that we're influencing the companies as well to transition. So I think it's a big picture, but I think fundamentally asset owners, super funds, pension funds absolutely need to be drivers of this change.
Yeah, Iris, what would have been the killer fact or the killer argument that got a company as vast as BlackRock, an entity as vast as BlackRock, to elevate climate in the way that happened in early 2020? From within the culture of the organisation, what was most important? Extreme climate events, the emergence of regulatory pressure, or a combination of what other factors?
Thanks, Bob. I think it is a coalescence, as Nicole mentioned, in terms of just reflecting back what we're hearing as a large global fund manager. So it is in response to, as a fiduciary, speaking to clients, particularly, as Nicole mentioned, in Europe, who are very concerned with some of these topics, and keeping in mind that, again, we're managing money on behalf of clients, so need to be incredibly receptive to them as one of our key stakeholders. I think the regulatory pressure is certainly one that in majority of the conversations leading into 2020 through 2018, 2019, as we were meeting with central banks, with regulators globally, in this increasing awareness that 2050 is not that far away, right? And particularly if you're an old fixed income fund manager and you start thinking about 30-year bonds, that's less than the life of a 30-year bond, right? And so it really did crystallize that the timeliness of this potential risk and goal that we were trying to achieve in Paris by 2050. So many of the regulators that we were speaking to as well were really bringing this forward. And regulatory risk is one that we do need to be very mindful of. And I think another one is just the broader move towards the various stakeholder capitalism model that we follow, and that is to say, employees. It's something that became incredibly important for our employees as well. And we aim to try to attract good employees for long-term careers. And increasingly, the various stakeholders that we play into, climate risk is something that is incredibly important to them. And they very much want to be aligned with a company's purpose, which is something we talk a lot about in our CEO letters as well, and with our own clients and with our own employees as well. So it was sort of a coalescence of all of those various factors. So clients, regulatory, market demand, employee demand, et cetera, that really brought forth this realization that there was a tectonic shift that was about to happen, and that time was of the essence. And so we really needed to bring this risk to the forefront. And if you've ever heard Larry speak, there's one thing that financial markets do very well, and that's when you can assess a future risk, they really try to bring it home, bring it back to that present value. And so once that came into focus, it really crystallized for us that we needed to think about how we were addressing this risk and whether investors more generally were focusing on this risk. And so it came back to the starting premise of, well, climate risk is investment risk. And so we need to look at it with that same financial risk, and let's be clear, opportunity lens that we would any investment, because at the end of the day, that is what we're here to do, is to be a fiduciary on behalf of clients and to manage both the risk and opportunities across the board and across their portfolios.
APRA is about to lay down new guidelines that will capture the private sector in this country, and crystallise what I think we've been talking about, and that is the risk that climate represents. Is there a sense that you're ahead of where the new APRA policy will be? Do you think there are sections of the private sector that are lagging behind what APRA is on the point of decreeing as the new standard for corporate Australia? Any member of the panel, James, would you have a response to what APRA is doing?
Not directly in terms of APRA, but bigger picture. I'll echo Iris's comments. One of the biggest drivers here is client demand. Now, the majority of our clients are institutions, not dissimilar to CBUS, and they are definitely driving demand for responsible investing and consideration of climate, and that's not just something that's happened yesterday. This has been present for quite a few years now, and that's hugely powerful because as a commercial business, it's in our interest to satisfy not just existing clients but future clients. So that's at an institutional level, and the same's happening in terms of retail funds. People are becoming much more aware of where their super, for instance, is invested, and becoming sensitive to that, in the knowledge that perhaps that's supporting activities such as coal mining, which they might not be happy with. And I think that's now flowing back up to the regulators and bodies like APRA and informing their decision making around that. Now, I can't comment about, so much about what we're seeing overseas, because we're purely a domestic business and we don't have any overseas investment management activities. But it's clear, looking to Europe, we can see the influence of regulation and political leadership on our industry, and that is also starting to filter down here to Australia as well, which is a good thing.
Well, let me run through the panel. Let me get a comment from each of you on how your organisation would respond to the prospect of investing in a sector. So, beginning with you, Nicole, thermal coal, a thermal coal mine. Can you say emphatically that CBUS would rule out any of your members' money going into such an investment?
I can talk about the way we've approached it at CBUS. So we don't have a sector-based exclusion for fossil fuels at this point in time. What we've done, and look, I'm going to take it back to top down and then talk about how we've approached this in our portfolio. Fundamentally, the way we think about climate risk, like what Ira said, is it's an investment risk and it's an opportunity as well. And our premise is that we invest in the transition. So what we want is our underlying companies and assets to move towards net zero by 2050. And that means making sure that we allocate capital to the right companies. And what we expect is that they will set targets, they will set interim targets, that they will have their capital expenditure directed towards green solutions, and that they start to transition their business. So that's what we believe.
Unlikely that a thermal coal mine would be able to demonstrate it's on a path to net zero emissions by 2050.
I think over time, absolutely. So the way we've thought about it is we have a stranded assets framework in place. Yep. And where we started, we have overarching portfolio commitments. So across our entire portfolio, we've set net zero emissions by 2050 targets and interim targets by 45%. Now, because we're with the building and construction industry, where we started setting those targets was in the property portfolio, and I can talk more about that in a minute. But then when we started our stranded assets, we started in one part of the portfolio as well. So the way we approach things at CBUS is we learn by doing. Now, what we did was we set up a framework and we identified metrics in our quantitative portfolio for our listed equity stocks. And what that does is this metric identifies forward-looking stocks, which we believe are not going to transition. So, for example, it's based on a model buying the stocks, and we think there's climate value traps. So we say you can buy apples and oranges, but you can't buy blueberries. Now, that for us is across the fossil fuel sector. It's not every company, it's the ones that we think aren't going to transition, and that includes thermal coal companies. So we've applied that for this quantitative part of our equities portfolio, and where we're at the moment is we're taking the insights from that to see how we can apply that and think about the concept of stranded assets, because you're absolutely right. I mean, we've got the concept that we need to invest in the transition, but there are going to be companies and there will be sectors over time that won't be investable and they will be stranded assets.
So these are the considerations that at a CBUS committee meeting or board meeting would figure if you looked at something in the fossil fuel sector. Is there a transition plan to 2050 and an intermediate one of 45% by what, 2030, 2035?
Yeah.
And is there a danger of the asset you invest in being, as a result of government policy and the shift in demand and other factors, a stranded asset?
Yes, absolutely. And so where we're at, I mean, these things take time. So going back to that quantitative model, that took us 18 months to basically identify the relevant metrics, test it, because we have a members' best financial interest duty. So we need to make sure that everything we do is evidence-based and that the implications for the members, it does what we want from a climate risk perspective, but it also does what we want from a financial perspective. Then we implement that and then we use those insights. So it takes a while to do that. Now, from a broader perspective, thinking about the assets and which we invest, the way we thought about our targets is we've developed scenario analysis. So we know where we need to get to under different scenarios by 2030, and then what that looks like by 2050. So we know that technically it's possible for us to meet those targets. We've done it under a range of scenarios, and of course the outcomes varies. Where we're at this point in time is we're looking at what that means for each asset class. We're also looking at what it means for each sector, because sectors will decarbonise at different rates and you need to take that into account. And what we want is the companies and assets in our portfolio to be decarbonising at the rate of what each sector should, and then either at each sector or above that line. We don't want companies that aren't transitioning that are below the sector average. Now, this type of information isn't really readily available. Like, as you say, Bob, the pace is moving so fast that we're keeping up, we're data hungry, we want this information, and these models are being developed as we speak. So it's just this continual evolution and work in progress. So we do know where we need to get to, and we're right at that point where we're identifying what that looks like. Now, that process to take our to get a baseline of our whole portfolio and then develop these scenarios took 6 months. So then it gives you an indication of the time that we need to be able to implement this, but we're moving as fast as we can, and we're looking forward to more data.
Well, if you're at a conference with representatives of Norwegian and Canadian pension funds, would you be able to say, as part of the exchange of information about your policies, that would you be able to say that you are doing no bit less than they? That there's not a sense in which you, as an Australian super fund, are performing slower or more tardily than the very best of the Scandinavian or Canadian pension funds?
Look, I think in Europe, they're driven by regulation, so they're probably moving faster. We're moving at the pace. I think there's a group of super funds in Australia who are all leading and are moving as fast as they can, given the environment and the regulatory framework in which we operate. So we're comfortable with where we're at, and it's an absolutely live discussion ongoing from our board down through our investment committees and with the investment teams. So it's embedded in how we think about it and how we operate on a day-to-day basis. And I don't know if we can compare like for like, but it also depends on your type of portfolio that you have. So for our portfolio, we think what we're doing at this point in time is appropriate.
Yeah. Is there any sense, Iris, in which BlackRock is different from CBUS? What stands out for you in what's similar between BlackRock and CBUS and where you might differ?
Now, Bob, are you trying to put me in a tricky situation? You realize CBUS is a client of ours. So it's hard to compare and contrast sometimes these things, but I think that is an important point, right? So we are, again, sort of a fund manager. And so we are managing on behalf of clients like a CBUS. And so very much we need to follow their lead as to where they want to take their portfolios and their investments. I think we share similarities in that, again, we have very much a long-term perspective and are very much focused on that risk-adjusted opportunities and returns. But I do think that clients like CBUS and very much like the other superannuation funds in Australia are very much taking a leading role in pushing fund managers and trying to encourage better practices from fund managers, but also from companies as well, because we haven't really gotten into the stewardship component, which we can discuss, which is that engagement with companies and really how we as a group are trying to encourage better long-term business practices at these companies that we invest in on behalf of clients, which all of us can discuss quite fulsomely. But in terms of where we see, CBUS versus BlackRock versus other clients, I mean, the reality is that globally, I think to Nicole's point, the Europeans are really leading from the front on these topics. And certainly those pension plans that you mentioned are also clients of ours. And so they are also pushing on us to engage with the companies that we invest in on their behalf. They're pushing us to create better products for them. A lot of our investments, again, are index funds. And so you're somewhat beholden to the index. So you don't have a choice as to what you own or don't own. So what can we do in that equation? Well, we can instead create better products for clients and working with clients like CBUS to say, well, actually, that index that you've chosen is actually not a great index. It's not a great index because it might hold the bad companies that you don't want to hold. So let's work together and create and invest against a better index that excludes some of those. But that is a conversation that needs to be had in partnership with clients and in partnership with the market that you're in. I've got to tell you, many of our clients in Alaska and Texas don't like our views and don't like some of the discussions we're having right here today. So it is a bit of a balancing act for us because, again, it's not our money. It's not Larry Fink's money. It's our clients' money. So we really need to be mindful of that, whilst making sure that they are clearly an important stakeholder for us and be responsive and receptive and forward thinking in their views. And what we can do is, to Nicole's point, is really try to bring out the data component of this, because it is a really challenging to try to find and bring together all this data. And that's where I think the power of our platform is helpful. I think that's where, when we're thinking about investment and investment risk, one of the things that we've done this year is bring in climate risk. Again, as we started, climate risk is investment risk. Well, let's look at climate risk and bring it into our capital market assumptions. So how do you bring that into the assumptions you're making when you're trying to allocate across different asset classes? How are you bringing that climate risk into pricing of securities? And how do you build that into the system? So again, the end investors can have a look at that and with transparency and make that decision and decide, okay, this is an apples to apples comparison. We'd rather invest in company A versus company B because they score better on certain metrics that are important to us. But those metrics might be different for various clients.
Iris, can I take a practical example? If I was seeking investment for a thermal coal mine, would I be wasting my time in going to your office and seeking money from BlackRock?
Okay, so if you had one of the commitments we did make in 2020 was in our active portfolios across equity and fixed income or other asset classes, if you have 25% or more revenue in thermal coal, you will be excluded from the portfolio. But that's in our active portfolios. That's where we as portfolio managers have the discretion to pick what goes in the portfolio. Again, the problem with that is that a majority of our assets are index funds. So we are beholden by IMAs, investment management agreements, by guidelines to invest in certain indices. So that is sort of within the realm, that's what we have to do. And so we may have problematic names in the portfolios that we manage because they are managed in an index fashion. So what can we do in that situation? Well, we can say, again, work with clients to say, look, that index really doesn't work. This one's a much better, if you want to have an exclusionary portfolio, like many clients do, well, we can work with the index provider and create this index, and we can manage against that index. We can't create the index because that would be against our fiduciary duty.
Is that the issue with Adani, the link between BlackRock and Adani? Because I've got 5 questions sent to me by people who oppose the Carmichael mine proposal and say it would be the prelude to other mine investment in the basin. And they're asking about BlackRock as the biggest investor in the Adani group. So just unpick that for me.
Well, Bob, I'm not surprised you have 5 questions. I thought maybe you'd have 25 questions on this topic. And I'm not trying to be flippant at it by any means at all, because it's a very critical, important issue and one we take very seriously. So again, in our active portfolios, we do not hold Adani. Where we have discretion to pick whether we like one company versus another, Adani does not feature. However, we still have holdings in our index portfolios. Those holdings are quite small, and I would question that number that we're the largest investor, because I don't believe that to be true, given what we know about their capital structure, given what we know about their free float, given what we know about the index component of it. So if you think about the Adani in an index, and then you equate that to our holdings, that would be essentially what we hold. So nothing more.
You're talking about a situation of managing a fund that has been chosen, that has investments in it, chosen by others. You're there as the manager.
We're there. We have a fiduciary duty beholden by legal contracts to replicate an index when you're index investing. And I think that's something that gets lost sometimes in terms of index versus active investment. We do both, but our holdings in Adani are explicitly index holdings where we do not have the ability to divest. In portfolios where we have discretionary capability, the active portfolios, we do not hold Adani. So our Adani holdings are predominantly to replicate the index as is necessary under our contracts. Now, what can we do? That's great, but what can we do? Well, again, we can work with clients to say, hey, there are different indices out there, look at those. We will create products versus those indices to meet those requirements that you have and to try to avoid this issue. Importantly, which we have, the issue we haven't gotten into again yet is the issue of stewardship. So what does that mean? So we believe we are stewards on behalf of clients. So what we do, we have the largest team, I think globally, in terms of more than 60 people whose day in and day out job is to go meet with companies and speak to companies and really try to advocate for that better long-term sustainable business practices, and really try to go in there and advocate and talk to companies and say, we need, again, that better transparency and disclosure so that investors can make those decisions. And so in that case, what we can do, the tools that we do have available to us in an Adani situation, is to use their AGM to either vote against directors, which we have done, or to vote against capital raisings that they might be doing that might impact certain projects, which we have done. We can also try to look at it through the value chain, which again, I know that I spend a lot of time with James and Nicole in various forums, and we do think about things across the value chain. So where else can we look at this issue, and how else can we think about this issue, not just at Adani, but who also is supplying to Adani, who else is providing capital to Adani? Let's have these conversations as well. And it's not, very importantly, I must say, it's not to try to tell companies what to do, but again, it's back to this concept of trying to encourage that business practice and have them think about this risk that they're potentially facing. And it's that risk of whether it be stranded assets, it's that risk of capital allocation. Is that a smart use of your capital if this is going to, this is going to be getting so much negative reputational risk in the market? Is this something you want to be associated with? It's really thinking about it through that risk framework. And again, opportunities for a good company, not necessarily Adani, but thinking about it in that framework where we can actually use our holdings and our quote unquote influence, which we try not to use, but say, that perceived influence, to have those conversations, to try to encourage that better practice, and or vote against the directors, which frankly is sometimes the only tool we have left in the toolkit.
A vote against directors.
Yes.
Yeah. James, would your policy permit investment in infrastructure linked to a coal mine? Or does that, and it's a question for all of you, does that instantly raise the question of the warning light, the red flashing light? This will be a stranded asset. Say, a rail link to a thermal coal mine. James.
This is where the argument around divestment gets a lot more nuanced. We explicitly will not invest directly in miners of thermal coal, but much of that infrastructure supporting that and other similar industries is absolutely investable. And I think the important point to make here is that one of the unintended consequences of simply divesting or avoiding such companies is that these companies end up in the ownership of investors that simply don't care. And if we're trying to achieve transition and these assets are owned by other capitalists that don't care, then we're probably going to be less successful in achieving that transition along a good timeline. So what we can do, though, is as active owners of those kind of assets, we can engage with the companies. We can make sure that they understand that they need to transition those assets, or that those industries are going to transition. And as responsible managers of our clients' capital, we will incentivize and hold those companies accountable. That kind of engagement entails sitting down with boards, sitting down with management, asking them to make sure they furnish us with the right information, the right data, to then start to hold them accountable. That allows us, for instance, to put in place incentives for managers that will actually reward them for achieving the right strategy, or implementing the right strategy for those companies to transition.
James, what would be the toughest question you'd put to someone trying to get investment funds from you for a bit of thermal coal related infrastructure, like a rail link? Would you be focused on what might happen if there's a panicky move by government in response to international pressure to get out of anything related to fossil fuels? Again, the danger of a stranded asset. A rail link or a port that's no longer viable because the mine has been obliged to close.
look, it's highly unlikely we would consider investment in that kind of asset because it's simply beholden to one industry, and that's the thermal coal industry. Our process identifies that risk, looks at the materiality and feeds that into the risk and the rewards related to that investment. And a sole asset serving that industry is unlikely to pass through that process in the context of our company. It gets much more nuanced when you find companies that serve that industry plus a whole load of other industries at the same time. That causes us then to focus on the exposure of total revenue to that one particular activity. And if it is of the magnitude of 20-30%, then we can have a constructive argument with the company and say, well, okay, you're serving other industries. We would like you to pivot or move towards serving those other industries at the expense of this one. And if over time the company responds, then we can support or withdraw our capital otherwise.
Nicole, a question of you. How close are we getting to putting gas in the same category as thermal coal?
Oh, look, that's the trickiest question of all, gas, the transition fuel and how long it will last. So, look, I think there's a couple of things to tie together here. So going back to your question around APRA and their guidance. So APRA regulates the superannuation industry. They also capture the banks and insurance companies as well. They've been talking about for several years now the concept of climate risk as a financial risk. They've just released guidance, as you mentioned, Bob, and it's guidance. It's not regulatory at this point in time, but what it does do is it channels the expectation and obligations of organisations through the frameworks from APRA that are regulated, such as the governance frameworks and the risk management frameworks. One of the key components in there is that it talks about risk management. So what does that look like for a superannuation fund? Well, basically, it's, you need to identify, assess and manage and mitigate these risks. And part of that for us is understanding the companies and assets in which we invest, which we've talked about, but it also means engagement. And I mean, my interpretation, and I'll caveat that, it's draft guidance at the moment, and my interpretation of it is that they expect that we do engage with our investee companies and our fund managers for that transition, but we're a prudent organisation where that's not appropriate anymore, and there are potential financial risks for our members and for their retirement savings, that we would no longer invest in that. For a gas pipeline, and the other point I wanted to make is one that Iris made as well, is about the toolkit, because we talk about divestment and exclusion, but it's absolutely one thing we have available to us as investors, whether it be an investment manager or a superannuation fund, to help manage this risk. There are a number of things we have. And usually for us, it's the tool of last resort. It's when everything else is failing, it goes through our escalation policy and it's divestment. And that's a serious thing for us. And it goes through our investment committee, be it a sector-based or a company. Now, on gas itself, it is a tricky issue. And the International Energy Agency identified that from 2021, they just released their new scenarios on what the energy transition looks like, net zero emissions by 2050, that from 2021, there should be no new oil, gas, thermal coal developments needed to transition the economy. So that's the first point, that nothing new should be built. So when you think about if you're looking to invest in any new assets or companies that are developing these assets, it raises an absolute red flag. The question then becomes around existing assets. What's their useful life? And say private markets, public markets, we're talking about stocks, listed equities, they're liquid. You can buy and sell out of them very quickly. And if you talk about private markets and gas and some of those assets in the infrastructure world, they're private, they can be privately held, they're illiquid. And so you're looking at it's a long-term hold over decades. So it becomes a very different proposition. So for existing assets, at this point in time, what we're looking at is similar to what Ira was saying. We start to bring metrics into our investment decision making. So what's the price on carbon? What's the scenarios look like? And what's the value going to be? Can they transition? Is there anything alternate? So we talk about the railroads or gas pipelines. There's a lot of talk about hydrogen. Can any of these pipelines be transitioned to a new economy and be useful in that? So there's a lot of different things and factors involved in making this decision. But gas, I think that's one that's it's still under discussion. And what's interesting is that Europe, who I know we've all said that they're leading in this space, they're still talking about gas. They have what a taxonomy, which we can talk about another time if relevant, that classifies economic activities based on their green or brown. They're still debating gas. So that's where it's at. It's a pretty tricky one to form a view on at this point in time.
Yeah, thank you. Iris, can you give us a view, given what Nicole has just said about the International Energy Agency report, that from 2021, no new oil, gas, coal investment. How does that feed into BlackRock's considerations? Would a report like that really commit BlackRock to being even more explicit, especially about the question of gas, which, as Nicole says, is still being debated in Europe? A sense of how BlackRock would take that report and its reference to gas in particular. Iris.
Yep, and if I may, I might just take a step back to say, not dissimilar to what Nicole said, but one of the things we are asking companies to do, and it comes back to this disclosure and transparency point, is to show us a business plan, to show us their business strategy to get to net zero by 2050 under less than 2 degrees. So a report like the IEA changes that equation a little bit in the sense of it's new information, right? And it's frankly new information that all of us as investors are still digesting and trying to really come to grips with what does that mean, particularly for some of these trickier sectors like oil and gas. Similar, I think, to CBUS, whilst we made a commitment on the thermal coal, the 25% revenue, there still is that bigger point as well in terms of divesting versus continuing to engage, because not only is it, you don't want companies, you don't want a conglomerate to necessarily sell off their thermal coal plant to a private company, but you also don't necessarily want them to sell it off to a government, think of Russia or something like that, right? Where you really have no say. And so there is this value to having these engagement conversations with these companies and asking them these questions of, show us your transition plan, show us your plan to net zero by 2050, and then using that additional information that is provided by the IEA, and how do you factor that now into those questions that you're asking? And there again, it comes back to capital allocation issues for them. How are they spending their capital, featuring these scenarios, and is that the best use of investors' capital? And those are the questions that we need to be asking companies. And that's the way that that kind of report would feature into our conversations. But it is still early days. This report was released not that long ago. And so we as an industry, I know, are grappling with, well, what does this actually mean for the sector? But let's also not forget, there are, again, we're focused very much on the risk component, but there are also opportunities. And we certainly believe that we should also allow companies, technology is going to be part of that future solution. We need to allow companies to try new technologies, to invest in new, in different strategies, to try it for abatement as well. So, it has to be a nuanced conversation. So we can't say that, oil and gas close tomorrow, because that's not part of the overall thesis, which is we need to ensure a just transition. A just transition is not just immediate closure. It's also, we haven't talked about workers and the potential displacement of workers, and how do you feature that into some of these climate plans to 2050. So this is all part of the conversation that we as investors are having with these companies and asking them to provide us with better information so we can then assess these companies and say, look, that company is actually taking these risks seriously. Therefore, we think we should allocate funds to them, versus this company is not only not taking it seriously, they have their head in the sand. We should, if we can, maybe not invest in them. And if we are invested in them, start thinking about their board of directors, start thinking about their strategy, and start voting against them if they do not take investor feedback on board.
Thank you. James Taylor of Elliston Capital, how would you and your colleagues weigh the IEA report with its bottom line conclusion that from 2021 there should be no new investment in oil, gas, coal? You take that seriously? That would feed into your investment considerations?
We absolutely take it seriously. This is from one of the global organisations funded by the industry that it's talking about. So that was one of the biggest surprises from that, was the severity of the implied change. The biggest issue is that with the complexities of energy systems vary from country to country, and it's great that we are now operating in a multi-stakeholder society. It's great that we have NGOs calling very loudly on other stakeholders to bring about change, to bring about just transition. The reality is that we also need good policy around this as well. And unfortunately here in Australia, we're sitting in a bit of a policy vacuum when it comes to transition and energy policy. And I put it to you that if companies or capital was incentivized to invest in, say, batteries and battery technology, then we might bring about the point at which we can take gas out of the energy complex quicker than the status quo that we're in at the moment. And you have the same argument around nuclear energy. It's very nuanced. Switch nuclear off where it exists, and energy systems don't work. Switch gas off at the moment, and here in Australia, and the retail prices are going to be probably going up, and wholesale prices are going to be a lot more volatile than they already are, and we're going to get more outages within the system, whether it be South Australia, Victoria, or New South Wales, and that's problems for everybody. So it is very, very complex. But what we can do as stewards of capital, getting back to your question, how do we approach companies that might be involved in the energy value chain? We have the discussions with them. How that informs their capital allocation. Will we be happy to see huge amounts of capital being put towards technology and systems that we think will be outdated in half the time that the company thinks they'll be outdated? Well, of course we won't be happy about that, and we'll try and bring about change in that thinking.
When you and your colleagues see headlines about extreme weather events, the floods in China and Germany and Belgium, the fires, the wildfires in California in conditions of unprecedented summer temperatures, what's happening in Siberia, what I started with reference to the permafrost, the disintegration of permafrost, the release of methane. Do you talk over morning tea about how these headline-grabbing events are going to force governments, even reluctant governments, to increase the pace of change, the pressure, for example, to arrive at credible targets for 2030?
Well, absolutely. Normally our conversations start off in terms of where they actually impact on companies that we might invest in. The insurance sector, for instance, is going to be feeling this. harder than anybody else. Owners of real assets, so infrastructure, property, and so on and so forth. Those assets that actually, suffer damage and suffer these weather events. If those owners are not, or those investors, the owners are not informed as to these risks, they certainly will be now, and they should be adjusting their investment policies to reflect these risks. So yes, it absolutely does inform our day-to-day thinking around investing in the sectors that have a material exposure to these weather events. But that's at an investment level. But as human beings, I think most human beings will reflect on what they see on the news in whether it be here in Australia or other parts of the world. And many of us are sadly old enough to be parents and are parents, and we hear it very much from our children. I'm forever chastised for the problems that my generation and my parents' generation have brought upon my kids, and that they will inherit, and that's a hugely powerful driver of our behaviour and their behaviour, and that ultimately will come into the system via how they choose to invest their savings, or how they choose ultimately to vote when it comes to determining who the policymakers are.
Nicole, extreme weather events, does it create a sense among investors that as this decade goes on, as we go into the 2030s, extreme weather events could force governments around the world to move almost overreact, to move unpredictably, or to move in an untidy fashion to meet the challenge of climate? And you've got to anticipate that. You've got to anticipate that in a panic, a government in 2029 or 2034 would snap extra controls and extra restraints in place that will leave you with stranded assets and investments that simply can't proceed.
Yeah, absolutely. And, I talked about scenarios before. So we look at our scenarios and our portfolio from a couple of different perspectives. So I've talked about the bottom up and the underlying companies and assets and what we expect of them from a transition perspective and where we want each sector to get to. But we also look at this from a macroeconomic perspective. So when we're developing our broader investment strategy and we're just getting insights into what we think our long-term 10-year returns will be for our members, last year, for the first time, we brought this question into that strategy. So we took a disorderly scenario and an orderly scenario. So from the Networking for the Greening of the Financial System, so it's the NGFS, and for those who aren't aware, that's really central banks and our financial regulators, ASIC and APRA, all getting together and identifying, working with other global counterparts and saying, look, we need to develop appropriate scenarios for the finance system to manage climate risk. So that's what we've been looking at in addition to the IEA scenarios. But to the point is they do identify disorderly scenarios. So we've put that into considering what the GDP will look like, will it impact inflation? And so we can start factoring that in from a growth perspective over 10 years, 20 years. But that's absolutely at the forefront of our mind, and we're starting to think about that from that bottom-up perspective, how it might impact companies. It's an absolutely key risk for us that if there is, these type of events will keep happening, and if there is a point where you have a shock and it's left too late from a policy perspective, the impact to pricing, the fuel impacts because we haven't acted quickly enough, is a massive financial risk. So we do account for it more broadly.
In other words, you accept there is a risk of a crisis response by government, by world governments at some point if the weather events gather pace.
Absolutely. And to your point, we've got to accept that things may not play out how we expect. So we may need to move quicker, and that may impose that shock, as you're saying, that we may need to move faster than what we expected.
Iris, what did Larry Fink's kids tell him about the need to move? What might have been happening? What might have been happening in the culture of your organisation, the ethos of BlackRock's head office that saw that big announcement in early 2020?
I might bring it back. I'll start with a very quick data point and then elaborate. So we do, like any hopefully good employer, do employee opinion surveys. We've done a heck of a lot of them in the last few months, and 90% of our employees globally feel very proud for the fact that BlackRock has taken a stance on climate risk as investment risk. So that gives you a bit of a flavor of back to where we started the conversation of an important driver of some of our actions is, again, employees and employee base as an important stakeholder. Now, to answer the question more broadly and to bring it back to basic principles, I think one of the most interesting things about 2020 and to bring it back to COVID was that you would have thought in such a period of upheaval, particularly when we're talking to some degree existential crisis in some of these companies and for some of our clients, and frankly for people, you would have thought that this issue about climate would have maybe receded a little bit, and people were perhaps more immediately focused on survival. And yes, that absolutely did happen, but it also didn't take away from the fact that our conversations on climate and climate risk intensified. And I think they did intensify because I think what COVID did do is really bring that future risk that was somewhat theoretical into a practical example and show what can happen if you're not prepared and you're not thinking about risk through the frameworks that Nicole and James have talked about. And if you're not thinking about future risks that might happen today, how does that impact your supply chains? How does that impact your employees? How does that impact the broader community that you're operating in? And so, despite all the tragedy that COVID has brought, it does, I think, have the silver lining in it, really bring forward that climate risk is, again, it's an investment risk, and it's one that needs to be taken seriously, and it's one that we need to think about today, because like everything else, it might be developing a lot quicker than what we think it will. And certainly from our perspective, as investors, and again, I see, James and Nicole on the panel, like, the pace of change, the velocity of change that we've seen just in the last couple of years, and our own intensification of conversations with companies and the developments that we as an industry are really trying to drive forward has been nothing short of remarkable, in the sense of this is now a very mainstream conversation. So again, across the platform that we operate in, climate is something that we're factoring in, and it's every conversation I think we have, some way, shape, or form, comes back to this issue. And I do think that COVID did accelerate that.
Yeah, James, were you surprised by the speed with which the carbon tariff, the carbon border adjustment mechanism, CBAM, gathered pace in the European jurisdiction? The EU suddenly got an idea that I thought would languish for a few more years, and it's proceeded through the Parliament. Take you by surprise?
Not at all. I mean, they've had a carbon trading ETS system there for more than a decade now. I'm pleasantly surprised by the appetite that the European authorities have shown to put in place, that scheme, for instance, and the whole of the EU taxonomy around the environment. It's hugely positive. As a capitalist, it's very easy for me to respond positively to putting a market price on an externality such as carbon. Incentives inform outcomes. Ultimately, what's very disappointing is that it's not within the political classes here necessarily understood that we live in a global system. So if other parts of the world start to put a price on carbon, then it will be imposed upon us whether we choose to adopt it locally or not. Any company exporting a product here will ultimately have carbon priced into it, whether they like it or not. Any airline that flies from this country will ultimately have to face that carbon tax if it wants to land in one of those jurisdictions. So it's disappointing that we don't see see an adequate policy response to that. But no, am I surprised about the pace? No, and I think we're actually already operating in a somewhat disorderly system, because that the pace of change required is far greater than that we're showing at the moment. I think we're going to see the stranded assets galore, not in 10 years' time, in 2, 3, 4, 5 years' time, in various sectors. Indeed, looking through the energy space, you can certainly see, or we certainly identify assets that we think are already stranded, and it won't take long for capital to reflect that.
For example, coal-fired power plants. What other examples would come to mind? Stranded in the next...
Clearly, coal-fired electricity generation assets in this country look pretty stranded to me, given the amount of days in the year that electricity has a close to zero price because of the huge amount of renewables that are coming to the system, which is a hugely positive thing, and that's clearly reflected in the strategy of one of the predominant owners of those assets, AGL, in this country. Clearly, they're acting with some haste now, but I think there's a good argument that they could have acted with greater haste in the past few years around that issue. But their strategy is to put that problem ultimately to the market, to put a price on those assets. So we'll see within probably 12 months or so what the market thinks about the value of those assets.
Other examples of assets becoming stranded in the next few years?
Well, there's a lot of this discussion around oil and gas exploration activities, and whether the billions of dollars that have been put into certain prospects around in the oceans around this country are worthwhile investments. I suspect quite a proportion of those prospects will turn out not to deliver a suitable return for the investors of those companies that are making those capital allocation decisions currently.
Gee, that's a huge development, isn't it, when we see the market making a decision about offshore oil and gas?
Absolutely, but that's really to the heart of our discussions and the decisions that we make as fiduciaries on behalf of our clients. You know, we have to make that judgment. We have to judge whether the companies themselves are making that judgment adequately, and then ultimately capital will vote with its feet one way or the other. And capital markets are highly sophisticated. They're international. They're global, in fact, and the wise money tends to move pretty quickly.
A yes/no answer from each of you. Is corporate Australia ahead of Canberra when it comes to formulating responses and policy on climate? Yes or no, James?
Yes.
Nicole?
On the whole, yes.
Iris?
Pick up a point that James made. It kind of has
Yes
to
or
be
no?
because
Yes or no?
yes, because
Yes.
of capital allocation, global capital allocation.
Well, that's interesting that you point to global developments. Paul Kelly in The Australian, source interesting, said in a recent column about a week ago that global capital would make a decision to avoid Australia if there weren't appropriate responses from Canberra. In the Murdoch media, I thought that very interesting. He was saying, in effect, and I'm sure each of you noticed his column, he was saying, in effect, that global capitalism make a decision that predetermines Australia will need to respond more decisively on climate. Any response?
I think it's not only global capital, but if you actually think of the markets that Australia exports to, they themselves are making policy decisions that directly impact the exports to those countries. So again, if you're thinking about it from a financial risk perspective and you're looking at individual companies, you need to be asking yourself, are these companies looking at this and looking again at that future and that potential future demand or lack of it, and taking that into consideration in today's capital allocation decision. So I think it's a two-way street. So I think, yes, global capital, but also our trading partners are as well are being quite strong on some of their targets. Whether or not they're valid or not is a different conversation that we don't need to get into today. But certainly,
you're referring to Japan, South Korea, and China.
Japan, South Korea, China have all made, yes.
Okay. This year is going to be dominated by climate diplomacy. Nicole, what sort of extra pressure will COP26 and the meetings that lead up to it put on the Australian government?
It'll be interesting to see, won't it, how this really starts to play out. I mean, it's hard for me to speak in terms of the Australian government and the pressure that it's put on them. If we just look at it more broadly of what the purpose of COP26 is basically that they ratchet up targets, and that's supposed to be done every 5 years, and this is the year that we need to do it. We're a member of the Paris Agreement, and therefore that's what we should be aiming for as a country. I think secondly, from an investor perspective, we have now an investor stream, which is the first time we've had that, led by Mark Carney, and very influential person with his roles as former governor of the Bank of England and Canada and chairman of the Financial Stability Board, leading that agenda. So I think there's going to be a lot more pressure on investors as well, both fund managers and super funds, pension funds like ourselves, in terms of not only our commitments, but evidencing those like we expect of companies and making sure we have transition plans. So I think there's going to be a lot of focus more broadly on countries, companies and investors alike.
Yeah, James, does the flurry of international diplomacy directed at climate have an effect on investment decisions? Does it vindicate those in the corporate sector who are asking for more decisive action, more explicit goals for 2030, tougher decisions that might affect investment in gas, for example?
Does it vindicate the corporate sector's approach? Well, I would like to think that the corporate sector's approach, informed by investors like ourselves, is based on science to start with. So it's a well-founded approach, and hopefully that's flowing up to that policy making and diplomacy, reflecting business as a part of society. I would hope.
Just something of a footnote. Can I ask whether there has ever been across your desk a proposal for an investment in a geoengineering adaptation to the climate challenge? That is, adaptation to climate change through an investment in an engineering solution?
I think I know what you're referring to, and I've started to see conversations around that. What I would say is that we predominantly invest in listed companies, and I certainly observe a lot more going on at the earlier stage investment space, asset classes such as venture capital and private equity, where there's certainly a great deal of new technological ideas, technology, looking for capital and finding capital, but that's not so much part of our business. So I don't see so much of that.
Does hydrogen figure bigger in all your calculations? Can I ask you that question, Iris?
And directly in my world, it's one of those things that when we're talking to companies, again, in sort of that stewardship role, that we're asking them on that business plan, on that transition plan, are you looking at what's your future, particularly for oil and gas companies? If the hypothesis is that oil and gas will fall away, what is going to keep you going in the future? How do you exist as a corporate entity if your main product has gone away? And so what other alternatives are you investing in? And certainly hydrogen is one that a few companies are looking at and are thinking about. And to an earlier point, I do think we need to allow, again, capital markets and companies to be able to invest in, and sometimes fail, because there will be failure. We wouldn't have progress without failure. So to allow some allocation of resources to these new evolving, developing technologies or sources of income. That's
Yeah,
good
Nicole.
diversification of risk.
Nicole, just extending that to you, and this is my last question for this evening, is there a single technological development in all that's crossed your desk that excites you, that fills you with optimism for a technological leap that might be very, very helpful as we contemplate the challenge of medium-term goals and the big goals for 2050?
Oh, look, that's a big question. I'm not sure I have a particular answer to that one. I think where a lot of, I won't say it's a necessary solution, but I'll say one market that I've seen incredibly active at the moment that is in its infancy is the natural capital space. And we haven't talked about that from the perspective of the role in carbon offsets or the role in solutions as well. And it's, you know, I've heard it's absolutely in its infancy. It's got the ability to sequester carbon in different components depending what we're talking about, whether it's mangroves or whether it's forestry. But I think that's an interesting area, and people are talking about it that it'll be another asset class. So I'm really quite fascinated to see how that area evolves.
Thank you, Nicole Bradford of CBUS, and thank you to James Taylor and Iris Davila. This has been a terrific discussion and very useful, and I hope practical as well. And I thank all of you who've tuned in. We've got some interesting panels coming up with a focus on the law and climate, given that a lot of battles are now being fought out within the legal system, both in Europe, Germany and Holland, for example, and here in Australia, where litigation over climate issues is becoming more marked, more productive. And we will be broadcasting an address by the Chief Judge of the Land and Environment Court in New South Wales on that theme of the law and climate. But to our panelists tonight, discussing the role of the corporate sector, all of you in agreement that the corporate sector is ahead of government, thank you for your participation. Please read the article in the Washington Post, though, about the disintegration of permafrost, because it lends further urgency to the matter we've been discussing for the last hour and a half. Thank you very much.
Thank you.
Thank you. Good night.
Thanks, everyone.
Christine, thank you very much.